With only 1 month left in 2024, we are again talking about stocks at record levels. It seems like every time we do this video segment covering top stocks to buy in the next month, we are again talking about stocks at record levels. And this is why I frequently say I prefer time in the market rather than trying to time the market. You can't count how many times I've been told, Mark, you need to sell and get out. There's a stock market crash coming. Even the great Warren Buffett has been increasing his cash pile waiting for a stock crash, one that has not happened yet. That doesn't go to say that a stock market crash isn't coming, but it does go to say why it is so important to maintain a well-diversified and well-balanced portfolio so that your portfolio can withstand any economic headwinds. And in today's video, we're going to be talking about 3 stocks that still look cheap, even with the market trading at record highs. But before we unveil these 3 stocks, show your appreciation with these videos we put out each and every week by clicking that like button down below. Subscribe to the channel so you're notified anytime we drop new videos, and let's jump into it. Hey everyone, Mark Roussin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we begin, let me thank today's video sponsor, which is the Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. And right now, if you go to fool.com/Mark, you could sign up to receive their 10 best stocks to buy right now. All right, let's jump back into our video, taking a look at 3 stocks that look rather intriguing from a valuation perspective, stocks that may look like a good buy heading into the month of December. Beginning with undervalued stock number 1, which is going to be Alphabet, stock ticker GOOGL. Alphabet, as you know, is one of the largest stocks on the market today. They are part of the Mag 7. However, they are the cheapest member of the Magnificent Seven. When you look at a forward estimate on a PE multiple, here's a look at other Mag 7 components. The highest is going to be Tesla at 101.9, followed by Amazon with a PE multiple of 33.4, followed by Microsoft with 32.3 times, Apple at 31.8 times, Nvidia at 30.6 times, and Meta at 22.4 times. And then there's Alphabet at 18.9 times. Might I remind you, Alphabet is trading at a market multiple, and this is a company that is still expected to grow its earnings 15% or more over the next few years. Right now, Alphabet trades with a market cap of $2.07 trillion, and over the past 12 months, shares have gained 25%. However, shares are down 12% from their highs set back in mid-July. So why are shares of the ad giant faltering? And why do shares look so incredibly cheap? Much of that has to do with the DOJ bringing a suit against the company to break up and divest Google Chrome. First off, this seems like a big ask of the DOJ, especially with a new administration coming in. But as investors, we have to consider all things. But looking at valuation, it seems like a lot of this is already priced into the stock. When you have shares of Alphabet trading at a sub 18 times multiple, this is a lower risk with a much higher reward is how I'm approaching it. Looking at this Fast Graphs chart here, we can see that analysts are still looking for the company to generate EPS of $8.95 per share next year, which equates to a forward PE multiple of just 18.9 times, like we mentioned earlier. For comparative purposes, over the past 5 years, shares of Google have traded at a PE multiple of 25.7 times, again, representing a massive discount. On a price to free cash flow basis, shares are trading at 16.7, again below their 5-year average of 17.9. On an EV to EBITDA basis, shares are trading at 16.7 times, again below their 5-year average of 17.2. So again, from multiple angles, we are all seeing that shares of Alphabet clearly look cheap. And if you are an investor willing to take on that DOJ risk, this could be the biggest bargain of the year. Analysts are also upbeat on the stock, rating it a strong buy, with an average 12-month price target of $208 per share, implying 23% upside from current levels. And that brings us to undervalued stock number 2, which is going to be Nike, stock ticker NKE. Now, Nike is a company that has been in the dumpster. This is a company in dire need of a turnaround story, but that's one of the areas that I'm kind of excited about. Usually I'm a little bit more patient with these types of stocks, but I'm going to show you what I've been seeing in shares of Nike here in a second. The company currently trades with a market cap of $117 billion, and over the past 12 months, as I mentioned, the stock has been in the dumpster. Shares are down at nearly 30%. So as you can see there, not a lot to like, especially if you already are a Nike shareholder, which I am not at the moment. But this is an area, and I'm going to tell you right now why I am willing to potentially start nibbling at this stock. First off, they are hiring a completely new management team, as they've brought back CEO Elliott Hill to lead the turnaround, a familiar face and one that is expected to not only increase morale, but also increase much needed innovation. Secondly, we may be seeing a bottoming in the stock from a technical perspective. Looking at this chart here, you can see that when the stock fell nearly 20% in late June, shares fell down to $70 in the week after. From there, the stock tested the $70 range 3 to 4 times, bouncing higher every single time. The stock then saw some momentum into the fall, climbing back up near $90 per share, again before falling all the way back down to that low $70 range. But what happened here again? The buyers came back. So right now, $70 looks like a firm support for shares of Nike. A third reason on why I like the stock: shares are dirt cheap from a valuation perspective. As you can see here, analysts are looking for the company to generate 2025 EPS of $3.16 per share, which equates to a forward PE multiple of 24.9 times. This is well below the company's 5-year average of 34.2 times. But in no way, shape, or form does Nike deserve that high of an average multiple any longer. So this is clearly a turnaround story, and one that you're definitely going to have patience for. But with a new CEO, looking from a technical perspective and bringing in fundamentals from a valuation perspective, this could be a great area to start nibbling. And analysts tend to agree, as they rate the stock a moderate buy with an average 12-month price target of $95 per share, implying 20% upside from current levels. And that brings us to undervalued stock number 3, which is Coterra, stock ticker CTRA. Now I'm going to leave you with an energy play. And with the new Trump administration, with Trump being reelected and taking office here in January of 2025, a lot of what he talked about on the campaign trail centered around oil and gas and the energy sector, which plays right into Coterra's hands. Shares of Coterra are up 15% since Election Day. They currently have a market cap of $20 billion, and over the past 12 months, shares are up just 2%. When it comes to energy, over the past 12 months, it has been the worst performing sector of all sectors in the S&P 500, with the sector up just 12% compared to the S&P 500 as a whole being up nearly 35% during that stretch. However, as I mentioned, with the Trump administration coming back into power, and on top of that, you have the Republicans taking control of both the House and the Senate, this could be a huge tailwind for the energy sector as a whole and Coterra. Before we go to valuation, let's first look at the dividend, because this plays a crucial role for investors. The stock currently yields a dividend of 3.2% with a 5-year dividend growth rate of 19%, although the dividend growth has been a bit sporadic. Now turning our attention to valuation, where earnings are expected to return to growth in 2025, with analysts calling for EPS of $2.89 per share next year, which equates to a forward PE multiple of just 9.1 times, below their 5-year average of 10 times flat. This is a company with a strong balance sheet, a cheap valuation, and tailwinds coming with a new administration that's focused on oil and gas and energy as a whole, could be a big reason to start nibbling at this energy play. Analysts are also high on the stock, rating it a strong buy with an average 12-month price target of roughly $32, implying nearly 20% upside from current levels. So if you're looking for a potential energy play and a solid dividend payer with a strong balance sheet, definitely check out shares of CTRA. So there we just looked at 3 solid plays to consider buying in your portfolio in the month of December and heading into 2025. Down in the comments section below, let me know which of these 3 stocks do you like best at current levels. And if you haven't done so, make sure you smash that like button down below. Subscribe to the channel, and we'll see you in the next one. Take care.